For the last 25 years, I've been in real estate, which is my passion. Back in 2015, I started working in the family office space directly for several prominent families on their real estate portfolios. With 70% of families losing their wealth by the second generation and 90% by the third generation, I then realized that real estate would be the missing component for families, allowing them to maintain their legacy and mitigate how much wealth is lost for future generations. It was shortly after working for my first single-family office that I started interviewing successful real estate families and industry experts. These conversations, combined with my first-hand experience of working for families on their real estate investments and currently investing on behalf of families, that has allowed me to share this knowledge with other family offices, family members, and family office professionals so they too can be good stewards of wealth. I'm DJ Van Kuren, and this is Family Office Real Estate Insights from the Family Office Real Estate Institute. Thank you for another edition of the Family Office Real Estate Institute Insights. Today we have Darren Laureano and Stu Laureano from Southern California Equity. Thanks for being on the show, guys.
Appreciate it. Thank you for having us.
So I'll tell you, the topic today we're going to talk about is something that I'm curious about myself, honestly, because I know nothing about some particular types of real estate that you guys are involved with. And so outside of the medical office, the hospitality, and multifamily, that's all what I consider plain vanilla. But you guys are into also do creative office, entertainment production, and creative campuses. So who wants to start sort of give me some insights and explain to me what are these three different types of property types?
Well, I
Yeah,
might
I'll
just
jump
do a
in there.
little bit of I just a quick little intro, and then Darren, you can take over on the nuts and bolts for sure. But
Sure.
yeah, I mean, we've tailored our business model. Darren and Terry created this to um, to serve the innovation, what we call the innovation economy. We serve innovators, and innovators today are content creators and digital production, the kinds of things that everybody uses, but they don't know what the nuts and bolts look like on the back end. And Darren's been a pioneer in that space for a couple of decades now. And it's one of his favorite topics. So Darren, dive in.
Yeah, no, I'm happy to. So yeah, Stu's right. I kind of invented this not realizing I was in the middle of inventing something about 3 decades ago. And one of the things we realized that was interesting, obviously we're from Southern California, that's where we're based. It's where Southern California Equity gets its name. And then our markets are all the way across the country. But the entertainment business was significant. Digital media content creation came in directly behind it. So all the internet content creators and all those media companies, they really pressed at the forefront in the early 90s. And I was there in the middle of it with a couple of good friends of mine. And we found a way that was interesting because they didn't fit in traditional office. So the users and the content creators really didn't fit in the three-piece suit with an attorney or an accountant in the office building. They were looking for specialty, creative, low-rise commercial space, and what we now call, or what is commonly called, flex creative office space, and in particular specialized in entertainment production, digital media production. So what we kind of approached that from is it wasn't manufacturing, but it also wasn't office. So what really was it? Ultimately, we determined it was digital media manufacturing. We make Pixels, the companies that we house, and then I attacked it from a different approach. Everybody attacks these assets and the investment strategy and the process all from a different place. I actually attacked it from occupancy. I attacked it of what is the most efficient way to understand how to get a digital content creator actually into the business to generate cash flow in the commercial asset and ultimately high returns along the path. And if I could cut that schedule down by being very, very good at what I call transactional confidence. if I could really be very clear about developing that path as fast as I could, then the digital media content creators would come along. So it really has to do more with, it looks very manufacturing, it looks very industrial, but it has a very creative office type feel. And again, it's low rise class A. We're able to do, we'll probably get into this in a minute. I'll let you jump in, but that's really the background of entertainment production, digital media production. So we have everything from movie production companies, commercial production companies, editing firms, post production, internet content creators. Now we're seeing AI just explode and be, big space for us to have content creators. The other thing that's interesting too, where you're kind of mentioning DJ about the campuses, the really interesting part of that is they like to cluster with each other. They like to be near each other. They like to be in same campuses, in similar backgrounds, in similar areas. They don't want to be far around town. And then the types of employees and the types of demographics that fit there is, like I talked about with the three-piece suit and the guy with the, coming up the elevator, they want to get off their scooter and off their train with their dog, and they want to walk into the office and hang out with their dog and work on their content and be creative. I always find that even something that we do, because the process for us is very creative. I'll kind of jump into that in a minute, but the really unique thing is it's difficult to say be creative right this second, right? Creativity just sort of comes and then you feel it and then you stay in it while you're in that mode. You could be in the creative mode for 12 hours and have a great streak, or you could have 3 hours of frustration just because you're not quite feeling that. So I think that's kind of the creative process of deal sourcing, sourcing different products, sourcing the assets, targeting assets. And then I created something that kind of went along 30 years ago, what I call the acquisition targeting system. We really developed a system, a method to deploy that I could teach my team, and my team's been together a very long time, 10 years plus, of how to deploy this asset targeting system so that we could really narrow down the advantages, opportunities, and the conflicts of each of the assets.
So one is that, I totally understand with people wanting to be around other people. I mean, one, it creates energy. Two, you end up making new friends in the same space. You're similar, probably because you're in that space.
Yeah.
And also, it leads to probably, I would imagine, additional creativity because you might be talking to somebody about something or you have a problem and you're able to just, talk to the person next to you or down the way, right?
It
Absolutely.
can happen any number of ways. You walk outside your building, you're coming going at night or whatever it is. But yes, you interact a lot with people and similar creative ideas. Yes.
So, would you say it's everybody knows WeWork and how that was, supposed to be there for the younger gen and stuff. Is it similar to that, but with a focus in the entertainment and creative area, or is there other differences?
I think that there's other differences. I mean, co-working is always an element of what we do, and we've done a number of different brands and placed a number of different brands in the buildings that we've done for co-working. In fact, I'm doing one in Venice. Actually, right this second, I was just evaluating the real estate for them on an asset that I did 10 years ago. Very similar idea, but no, it's actually independent campuses. So I've done some very unique ones. Lantana in Santa Monica is a very well-known entertainment media campus, 500,000 square feet, 5 different buildings. We actually did a 6th building that's not part of the campus. It's right next to it. It's one of our case studies that we talk about quite a bit of industrial conversion, just because it fits the model very, very well. Another campus that's kind of well known here in LA is campus at Blackwelder. I did with a bunch of colleagues of ours and oversaw the deployment of that whole campus. It was a bunch of metal shed teepees, essentially. I mean, they were barely even buildings. There's 16 of them, and we maximized square footage. We maximized the use. Had still gave it that industrial flavor, but put a bunch of entertainment companies in it. So it was a campus of separate entertainment companies in 16 different buildings. And then they started sort of growing along the way outside of that. But that was the foundation of it.
So you mentioned about different types of media and stuff. Is there any types of equipment that gets used by multiple companies? I mean,
There is.
because or is there a special areas within some of these campuses that is specifically for, I don't know.
Yeah, There is. That's a good question. My background actually is originally as an architect when I actually first got started, and I was doing sound stages and creative spaces. One of my very first clients was a company called Media Ventures, and it was Hans Zimmer was the composer, very famous, done lots of movies. And I was super young on the team. I was fresh out of school, and I was doing his building. But that's actually how I kind of got into this was recording studios, post-production facilities, screening rooms, very sophisticated sound stages, live audience stages, and being very, very understanding of how those work. But the answer to your question is yes, they all need those types of facilities. They need their specialty in each of the assets. Some of them run 4 or 5 different stages with a large main stage, shoot 4K, 8K. You have to understand how those work very well together to pre-position the resources necessary to attract those types of tenants to your assets. Or as Stu always puts it, high credit tenants, single occupants for long-term leases, which is how we sort of look at it financially for the fund and how those assets go. That's how we analyze them because that's the holy grail of commercial real estate.
So are these triple net properties then?
Yes, mostly, yes.
And I'll tell you, have you guys, so are you anywhere else other than Southern Cal? I mean, Atlanta has a big media area, right?
Yeah,
Yeah,
there are a few other markets too, and Hollywood South is what they're saying Texas is now. Austin is one of our key markets, and they call that Hollywood South. We've got uh, South Silicon Valley is Miami, where they're trying to put all these tech companies, and there's a lot of migration and into these creative districts. The districts all have a similar characteristic or quality. We call them innovation-led submarkets, and they look very similar as far as their demographics. What we do is adaptive reuse, so we're converting spaces that look like industrial buildings and make this whole cool new vibe in the cities that we're at. Nashville is our other market, and that's very media centric, and these communities just blossom out of the space, so we can kind of parachute in to any one of these things, and our model works because it's system based and this clustering effect. Everybody has the same desire to be in these similar environments. The occupiers have this clustering effect that works well for our business model for sure.
And most of those DJ most of the content creators and the brands that we know very well that we're all familiar with, they have mandates for sustainability. I mean, they just do. In their corporate structures, it's just woven in there. And while I didn't intend this, to be honest with you, I effectively invented a system of adaptive reuse that was invented sustainability. So we're able to take these distressed existing assets and repurpose them through what we call a deep reposition method and bring them totally new life. And we originally do it for a very good reason, but the sustainable function of it is amazing. And the tenants like it and the brands love it and they tend to be attracted to it. It's a good story, but we had a practical issue there too, which was it simply was faster for us to deploy the adaptive reuse model. It resulted in bigger buildings and it resulted in less expensive buildings. So we were able to tackle 3 big parts of asset acquisition and then bring in sustainability to it. So we really felt that it was just, and I was able to perfect it over a long period of time. And now we're deploying it, as Stu said, in multiple markets.
So is there, what type of area are you really focused in on? And are any of those opportunity zones, or it doesn't matter? I would imagine it doesn't matter, probably.
Doesn't matter. It very well could be. What we target is urban infill more than anything else. So a lot of central business districts are surrounding that around metro type connections, which is where there's transport and transit. Opportunity zones are certainly fit that criteria. But I don't know if you know how well Los Angeles. Silicon Beach is what they call this tech centric area down here, and Darren's built a huge percentage of it over the years.
100.
So where are you seeing the most growth in this area happening? Is it still in Southern Cal, or is it in some of these places that you mentioned earlier?
I think it's the ones that Stu mentioned earlier, the demographics we see and the shifting in populations and the shifting of highly educated creative users is really pushing towards Austin and Nashville, Tennessee in particular. I invented this strategy actually about 3 years ago, 2022 now. And now it looks like I had a crystal ball, right? If I had a magic wand, it would be better, but I'm going to settle for the crystal ball because those are very hot markets. All you have to do is open up a headline and you'll see a who's who of every single brand, digital media or tech brand moving to those areas. So, and Miami, I think, is always kind of like LA, where it's always sort of sustained has a creative structure to it that, flourishes no matter what. It's just finding new ways to deploy in those markets.
What is Atlanta one of those markets or not really?
I think it could be. I wouldn't see why it wouldn't. I think Atlanta would be great. It'd be a terrific place. I think ours is more of a focus of diversity, of just being able to um, allow some range for de-risking the fund and making sure that we had a variety of different types of areas and different size of areas. Atlanta's, it's a very large area, so we kind of like that. We kind of like putting in Nashville and Austin is very, very welcoming markets and very wonderful markets and the right size along to go with LA and Miami. Now LA, we have home field advantage, right? So there's March Madness is on, and I love sports. I think you played sports. So we like home court advantage. So we have a little bit of that in LA, but the other markets are equally as good.
So what type of returns have you seen on this property type?
Our fund,
Do you classify it under office or under industrial? What would you
office.
categorize the property type? Office?
Yeah, you categorize it as office, even though you're reinventing manufacturing, digital manufacturing, but it's office. Our returns are pretty high on the facilities we do. When I'm, doing acquisition, disposition management, what I call the 7 essential disciplines of efficient investing, we're probably seeing around 32 IRR probably coming back for most of these. They're pretty high. I generally don't say that a whole lot because I think it kind of freaks people out a little bit. But the fund projects 22 to 27 is where we're projecting the fund to be on average.
I've got to. My assumption would be that you have. Yes, it's office, but it's not in the office category like every other office, a traditional.
Yeah,
Is that fair to say?
that's
Yes.
exactly right. Yeah, they're very fair to say. We are flex creative office. It relies on a model of both rentable area, exterior usable functional space that you can convert. What we've seen in the pandemic recently kind of proved that out. Our assets were very resilient. They stayed with tenants. In fact, they re-upped some leases during that period of time. They came back to the office faster, but the buildings were more flexible. They relied on interior open areas, kind of deprogrammed, very open office vibe, exterior spaces, and then part of our adaptive reuse method or our deep reposition method, we use mezzanines or expand the roof area and try to stay within the envelope of the industrial building if we can, but we're okay to push out of it if we need to, and we find creative ways to do that.
Hmm. So how big is this market really? Because I mean, I would think some of those categories that you're mentioning is growing, right?
Oh yeah.
And I could see a lot of them really growing, but is that something, and it's got to be speeding up too, I would think.
Yeah.
I'm just making those assumptions, but how big of a market do you actually think this is? It's obviously you guys have planted your stake as the people in this area, but how big is that market?
Well, there's kind of some handful of key market drivers. Number one, the technology boom. Those are our target occupiers, and those occupiers are looking for the kind of product that we create. And they're premium occupiers, like Darren said, they have low carbon mandates. So the tech boom is probably the biggest driver. And right now, return to office is a big thing, especially in the creative space, probably was on the front end of that. But, most of the CEOs, I saw a study that KPG did, 80% of the CEOs want people back in the office for that creative and that culture, but it's really a driver on the creative side. To innovate, you need to kind of be around that, like we talked about before. And really the way corporate earnings are on the grow, it's causing a demand for premium product, and that's really where we fit. There's a flight to quality. You've probably heard that, and we are where that flight ends. We're the departure. We're the destination for flight to quality for those kinds of occupiers. We're a middle market product, which we believe is a huge advantage. The institutional stuff is way more commoditized. The smaller investors can't do what we do, and we've created a model that goes from the occupier and works back. We're looking and working a lot of times with tenants that are currently in the market, acquire and redevelop as their needs are growing. So those are some of the key market drivers.
That is one of the advantages that Stu discussed, which is we are able to deploy buildings customized for tenants currently in the market because we can move so much faster. So
Well, you also have the experience and the knowledge, right? I mean, you understand what to do. Where if I went out there and said, I'm going to do the same thing, yeah, I'm starting from, I'm flat footed, and now I got to figure out what's
yeah.
better, right?
Well, the one thing that we rely on, and we'll come back to the size of the market, I think, in a minute, but one of the things that we rely on is we have all in-house sources of information. We don't source deals outside. Yes, I have some very good relationships with commercial brokers that source some deals for us publicly listed, properties and those types. But I've known those guys for 20 years. They know nationally exactly what I want. They've seen me do it time and again. They know exactly the types of animal that I'm looking for. So they feed that to us. But we also source our own deals, but we don't rely on any outside due diligence. We do our own. We know what we're looking for. We deploy the acquisition targeting system. We check our feasibility and our due diligence. And what I always tell people is we don't acquire buildings without having direct, exact, and I think exact is the important word here, information to 4 questions before acquisition, not after. Okay. What can I build? How much of it can I build? Where can I build it? And exactly how long before somebody's going to let me build it. So those are our critical questions. They sound very simple, but you have to accurately, predictably hit those before acquisition. Stumbling on the answers because outside sources took some guesswork or really weren't reliable or dependable, or oopsie, I got the wrong information later. But stumbling on those answers 6 months or a year later, you're hemorrhaging IRR, you're hemorrhaging return on investment just simply over time. And it's not necessary if you know where to look for the information.
Well, I also think that you probably have to be or have been gathering data too to know where something might work based
Yeah.
upon a number of variables.
Yes. I often tell people it's been, there's a lot of things I say a lot frequently, but one of the things is that small
I can vouch for
buildings are
that.
not, yeah, small assets aren't automatically easy, and large assets are not automatically complicated, right? Um, Complicated is really a function of, you know, how the asset's set up and what kind of conflicts are on the property already. And we just have a different philosophy. Conflicts to us are opportunity. Conflicts to everybody else scare them.
I believe in that as well. When people are running one way, all of a sudden I'm like, there's an opportunity here, right? Because
That's
everybody wants to go the other way.
that's
So
what that's what I realized.
so you brought up the word fund a couple times. Do you have other assets in this fund, or is it strictly really focused in on those areas that we've been?
The only other one we have in there, and it's kind of a really specialty reason, it's sort of tailed in there also, is medical biotech. Medical biotech is kind of the same type of animal. It's just another level of specialty that
Yeah.
people struggle with, and certainly with AI coming, the investment in AI towards medical development and biotech is enormous, and it's exploding. That kind of comes full circle to the other question about how big is the market between entertainment, digital media, content creators, gaming studios, and medical biotech. I don't think there is a limit at this point.
So what's the exit strategy? Is it institutions? You had mentioned having long-term leases, which are important. Triple nets are important. What's the long-term exit strategy in properties like property types like we're talking about? that has this creative function to it?
Yeah, I mean, our goal and our term for our investment in the fund is 5 to 7 years. That's really the exit strategy.
We mean to
The
sell to
institu
who? To sell to
to
who's the buyer at the end?
the institution, yeah, I would say they're package deals. Sometimes they obviously really like campuses. If we can cluster 3 or 4 assets together, that'd be terrific.
Yeah.
But certainly, individually, they tend to be very sought after also. But if you can bundle them together, particularly in what like we called in one of the sub-markets, they might be targeting 4 or 5 assets for an institution, pension fund, endowment, or similar, in a particular market, clustered together with 4 or 5 buildings. So if we can package them up, that's ideal. That's what we're going for.
What's the typical size, debt and equity for a building?
The deals that range from 20 to 50 million probably per deal, depending on what we find. The perfect model is about a 40,000 square foot, low rise, class A creative office. That's what we really go for. We can make it work down to 20,000. We can make it work a little higher to 50, 60,000 is great. But the sweet spot's 40, 50,000 square feet, low rise creative.
So then if you have excess demand, you just build something else then? Is that how you take
Uh,
up some of that, excess interest?
It depends. Everyone has, different opportunity. Probably a secondary function for us is to build new. We like adaptive reuse. We like the model, but we certainly wouldn't pass by an opportunity to build something new nearby one of the other assets or something. So we would infill in a vacant lot or a vacant property somewhere in the urban market.
Got it.
I'll tell you, if
That's,
you visit our LinkedIn profile, you'll see a lot of befores and afters, and it's makeovers that you never really thought possible. So that urban infill is really our sweet spot, as we've said, and the target asset and acquisition can be anything. Darren's mastery of the jurisdictional issues, using those as leverage. It can be retail that's gone south and it's in the right location, and we convert that into beautiful low rise class A flex office space. So
I
I would
think
get
that's one of
Go ahead, sorry.
I was just going to say, I think that's one of the things about having expert in-house sourcing for those 7 disciplines that I call it: the fiduciary management, acquisition, disposition, regulation, development, architecture, construction, management, leasing. If you really have delved into that deeply, you can put transactional confidence into all the people necessary to have those deals move quickly and successfully.
I mean, I would think that this type of property, I mean, one of the things that, at least for me, is one of the favorite components to real estate is that you're able to, I'll often use the example of if you paint a room, you just one stroke and all of a sudden you see something changing, right? You don't have to wait
Yeah.
20 years, 30 years type of deal. And I would think that this property type with what you're doing would actually be really fun.
It is fun, actually. It's interesting that you point that out. Yeah, I've had a great time with it. I didn't really know, like I said, 30 years ago, that I could I really told you that I was starting something, new or inventing something new. No, I didn't, and I don't think that people I was doing it with at the time they would say that either. But as it progressed, we were just, those guys that, creative guys in the right place at the right time, and began to pick up the phone from people in the market, and we started customizing space for them.
Well, I'll tell you, I love it. You don't come across a different take on a property type too often. And so
Yeah.
it's exciting that to hear something different for sure. Um, and I'm looking at some of these pictures of the different places that you guys have worked on, and they look pretty awesome actually. I
Yeah.
have a great appreciation for the creative side because my daughter's an animator, so I've sort of
Okay. Yeah.
come to appreciate that even more.
Yeah, you do need very skilled architects, day to day. I don't do that anymore, but you need very skilled creative people who understand this model, who are trying to adapt to what you're teaching and telling them, who find value in what you're teaching. And we've done that. We've had great relationships Now in Southern California Equity, we have a vertical platform. We have our own in-house studio that we've started
Mm.
to handle our own from people that we've had. And I think this is really important. I really want to get this. I have a great team. I have a wonderful team of people. Most of us I've deployed, I've taught them my system over a decade. Some of them I've known for more than 30 years. Two of them I've known for at least and worked with for 30 years. Stu's my brother here, investor relations, doing a fantastic job. He's been in real estate marketing, professional for, I don't know, 35 years probably. We've known
Yeah.
each other our whole lives. So those are exciting things to me. So I guess, I just want to say that you have to have when you look at that creative product, you have to have creative solutions from creative people. And I have some of the best, and they're wonderful people.
Darren, Stu, this has been a breath of fresh air, like I said, because it's definitely something different, right? Entertainment or creative office, creative campuses, entertainment productions. With you guys, Southern California Equity, what I'm going to leave with one more question for you guys, and that would be, where do you see Southern California Equity in relation to these areas that we've been talking about 10 years from now?
That is a great question. I'll let Stu finish that up, but I'll jump in with my diversity of product range that I've worked in, I think is our advantage. I can deploy funds in all sorts of different interesting markets. The deep reposition method, the adaptive reuse is not constrained by a entertainment product type or a sector. It works just as easily in multifamily, commercial condominiums, student housing. It works in affordable housing. It works
Hospitality.
in hospitality, commercial mixed use development. It works in retail. It works in all sorts of different components. You can see most of the work that we've done. I think with the diversity of product that I've done is probably what I'm most proud of. But the answer to your question is, I think, a multi-billion dollar, multiple funds, fund 3, fund 4, at least, in a number of different strategies that are kind of different. I'm actually excited about some of the housing stuff. I have that planned later on. Everybody's kind of really into that right now. I like the creative part of what we're doing right this second, but those are down the line. A hospitality fund would be great too.
Well, it definitely seems like you've cut out a niche and something that's definitely special and different. And so, personally just keep hitting that as hard as you can, as long as you can, right? Keep flipping the burgers. Let's keep flipping the burgers.
Yeah.
Guys,
Yeah.
thanks so much for being on the Family Office Real Estate Institute insights and getting to know a little bit about you guys and what you're doing, which is very exciting. And we'll have to have you back on the show again. We'll talk about some other property type at that time.
Yeah,
Sounds
big
good.
exciting. Thanks, DJ.